Hey guys, thank you very much for joining us for another episode of CFB Talks Digital Assets with myself, Ken, and my colleague Gabe over there in New York. Hi, Gabe.
Hey everyone, really excited to be here today and to talk some markets again.
Yeah, it's been a little while since we actually talked one-to-one. We've had some amazing guests over the last several episodes, but that's kind of detracted from our usual way of talking about markets. So, Gabe, to say the least, it's been an eventful last several weeks. What do you think?
Yeah, I mean, these are some, I think, some events that not too many people would have forecasted 3 months ago. And in our 2023 outlook, we talked a lot about this macro headwind shifting to a tailwind sometime this year. And 2023 has just been kind of a roller coaster of a year as far as these shifts in the narratives. Every month seems like we get, we're going to start to see maybe a sooner than expected pivot in January. Then in February, that becomes off the table. And now in March, we see these spectacular collapses of these institutions, across the board in the U.S. and now, in Europe with Credit Suisse being acquired by UBS. So it looks like markets are kind of starting to price in some dovish Fed policy in the future. There's at least a lot more uncertainty again. And this is something that, we're just going to have to kind of see how things shake out. But, I don't know. What's your kind of quick take on this?
I mean, Gabe, you look at the markets, we talk, you mentioned all that, which is, it's actually been a crazy year and it's only late March, right? But then you look at all that, you see that the S&P year to date, was it 70% still higher for the year? I'm no, sorry, something like 3.6%.
Yeah, I think a little more flattish, but I know what you're saying.
The Nasdaq 100 is still 17%. It's a better part of 20% higher for the year in a year like this. And of course, crypto, we're in a phase where crypto is commensurate with risk assets. Bitcoin has rallied those 8 big figures to 28. And then, it's come back in the last couple of days to 27. But that's still a massive uplift from where we were in December. What is going on, man?
Well, I think, we talked about this before where 2023 could be a perfect environment for crypto in a sense that when you get that shift in the macro from the headwind to the tailwind, but you're not quite seeing the fundamental side on, corporate earnings or profitability because these fundamental things that you look at on a traditional asset class like equities are likely to still be challenged with margin pressure. So inflation's still probably going to be running hotter for the time being. That's going to put some pressure, I think, on margins. It's really just about, who's kind of like the least ugly duckling. And when you look at digital assets in particular, Mike McGlone likes to talk about this a lot. He says it's the fastest horse in the race. I think that traders, investors are just really quick to get bids into the digital asset space whenever you see potential shifts in macro, whereas equities might be a laggard. It's already starting to play out in the price action. When you look at the spread between, our CF diversified broad cap index versus, something like the S&P, there's a really, big outperformance gap between these two asset classes.
I mean, you were saying earlier that what we had year to date still pretty much applies, was a broad rally for the digital asset class, crypto, led by Bitcoin and Ether. But it became a bit less broad since of early March.
Yeah, so every 3 months, we like to do this exercise, a quarterly attribution review of our indices. So these are all of our multi-token indices. We have reference rates, which settle derivative contracts on like the CME, like the Bitcoin futures. And then we also offer these wonderful multi-token indices that have either, thematic exposure to certain segments of the digital asset space, or they focus on certain market cap thresholds. If we look at the performance from, let's just say, the last rebalance period, which started in December 1st to March 1st, you would say that the overall performance of the digital asset space was very tight and it was all positive. So it was very, there wasn't a big dispersion, right, between different segment groups. It was all just broad-based rallies. Now that we've kind of fallen into this new, I would say, this temporary regime of uncertainty surrounding, financial institutions and their stability, we've seen Bitcoin in particular outperform other its peers. So if you look at like anything like the Bitcoin Ethereum ratio, which is something that we look at a lot, it's basically shown just that dominance. And if you look at the performance of our multi-token indices, it's our UltraCap 5 index, which has the highest relative weighting to Bitcoin, and that's why it's been kind of the star outperformer for the month of March, which we're coming to an end at. So this is something that we're keeping an eye on. I think it's important to kind of see. It's something that I like to look at, which is how broad is the digital asset rallies? How broad is the price action? Is it just a few tokens? Is it more of a secular trend across the board? But no, I'd like to ask you. We've got all this uncertainty surrounding the banking crisis. Do you think we're kind of getting to the other side of it, or you think we still have some more dominoes to kind of knock over, some shoes that
it's the very nature of these kind of things, as as many sort of famous commentators say, the very nature of a crisis that you can't predict exactly what's going to happen next. Two things I wanted to mention. The first things first. There's just like in sort of like you might want to call it TradFi, traditional Wall Street, traditional markets. There is a narrative that carries trading in terms of sentiment on a day-to-day, week-to-week, maybe month-to-month basis. And in crypto, it's we have our own corollary of that. And I guess one of the main threads of that is this whole thing that crypto is a kind of a safe haven, a sort of like a counter trade. It doesn't. I'm not saying it's applying right now, but is there a little bit of a flavor of that that you're seeing? That's maybe one of the drivers. I think it's incorrect. I think you're probably going to agree it's incorrect, but it did look like to me when these banks collapsed and when the conventional markets, tumbled sharply, and Bitcoin and Ether and maybe a few others didn't tumble so fast, that people were like slightly hedging their bets, slightly crazily with crypto. Am I wrong in that perception?
There's like a thesis, right, with Bitcoin in particular, where it's this store of value, it's global collateral, it's this and that. You can access it 24/7. You can trade it. As long as you have an internet connection, you can get a transaction through the blockchain. Basically, what I think we saw in March with the SVB collapse, with Credit Suisse, and why we've seen such this bid up in Bitcoin in particular, is actually more, I think, on the duration, which is the interest rate sensitivity of the asset class, more than this thesis, which I like to call the sound money thesis, which talks about this concept of Bitcoin being this sound money because of its, fixed supply, this sense of scarcity, etc. And the way you can kind of measure this, and we did a quick blog post on this, is we just compared the relative risk sentiment price of the NASDAQ 100 to the S&P 500. So the NASDAQ 100 is mostly comprised of infotech sector companies, which are particularly sensitive to changes in interest rate expectations. And if you take that as a ratio and then you just simply price, Bitcoin next to it, you'll see that relative risk sentiment in these duration sectors versus Bitcoin kind of moved in lockstep. Where we saw, I think, a real dispersion of this was back in October. All right. So in October, we can get maybe a more of a local take here. We had the new UK Prime Minister come in and I think propose some, potentially very inflationary.
Talking about sterling, right?
And that caused some really big turmoil. I mean, we were talking.
I'd say that's temporary.
Yeah.
That was definitely.
But there you really saw a lot of bidding in Bitcoin.
Indeed.
And you
showed
did not
the potential
see,
of what
the same relationship on the duration segments of the market on traditional asset classes. So there's that big gap that opened up. And I would argue that when you do kind of get these exogenous shocks to some major fiat, G10 currencies like the euro or the pound, which, we saw plummet very rapidly. it does make sense that you get a lot of price bolstering in the crypto space. But I think this time it's a little bit more on just the interest rate expectation side.
Yeah,
So
fair
I
play.
think, personally, I'd like to get your opinion, but I think, we're running out of runway here with the
No,
Fed's
absolutely.
rate hike
That, I
cycle. So
100% agree. I mean, in many ways, the elephant in the room, and it's in the elephant in the main room that includes crypto as well
right,
as traditional markets, is of course that we've had these classic yield curve inversions, which are pretty much fail-safe in terms of their predictions of downturns or full-blown recessions in succeeding years. We've had several of these. Obviously backed by, we're in an environment where people are looking at the Fed following the banking crisis that we mentioned and speculating that this will be sufficient to actually enable the Fed to take its foot off the pedals. We're not really seeing any sign of that. So,
I think what you got to do is keep in mind that when we look at some leading measures, and one thing that I like to look at is the relationship between producer prices and consumer prices.
yeah.
This is a good leading indicator for where inflation is going to go. If PPI is really starting to really roll over, I would expect a little bit more downside on the consumer price side. I think that policymakers were in a tough choice this past meeting to not really overly spook the markets
Yeah, that's
by
clear.
pausing. I
Mm,
think a 25 basis point, hike in this month was really kind of just maybe their last step that they could take forward. And I think I would anticipate that they're going to pause here soon, but they really didn't
yeah,
want to spook the markets because I think if
absolutely.
they would have
Not in this
paused,
environment. Yeah,
or even cut,
yeah,
a
yeah.
lot of people would have started to extrapolate out some doomsday scenarios saying like this is it, this
Mm,
is the big
mm,
moment, and maybe that. But what I'm thinking is that when you see the financial conditions, the way they're kind of tightening, when you see the way credit's going to be
yeah.
tightening with all the financial instability, I think
Mm,
I think the Fed is going to be a little bit more relieved in a sense that they're going to be more confident that inflation pressure should continue to cool down, and they'll be more comfortable pausing and then eventually starting to cut
mm,
rates. Right now, markets are still anticipating, basically 50-50 for the next meeting, and then a
sure, sure.
potential cut in September, which in my opinion is a little bit too far out there. But
Mhm.
yeah, I don't know. I mean, what do you think? Do you think we can get to September before a rate
I don't
cut, or do
know.
you think it's going to come
It's
sooner?
slightly. Someone asked me the same question earlier today. It may have been online, and I was thinking, I just can you imagine a rate cut before November even? I
I
can't.
certainly
I
can,
mean,
but
there are people. I think BlackRock is, one of our clients, is predicting no rate cuts
yeah.
this year. I mean, November is pretty late. It's kind of like a lame sort of rate cut at the end of the year. I think is there a meeting in December? I think there isn't.
Yeah, there's a December meeting. These quarterly meetings are the big ones. So that's
Yeah,
when we get
but
these.
obviously in
Yeah.
December you're not really doing anything. So if I'm saying November, or if a lot of people are saying November, it's like, well, why would you cut in November if you haven't cut before then? So I agree, kind of with the people who say that don't expect policy to change, in terms of the path and the gradient. Don't expect that to change much, before the end of the year. And of course, the
Uh,
upshot for digital assets is what? What do you see in terms of the reaction? If we're saying Bitcoin has become again the most important digital assets in more ways, obviously in terms of market cap, it remains that, but in terms of visibility, profile, performance, even it certainly seems to have taken back some of the initiative, from some of these upstarts, right? What do you see the behavior, some patterns of Bitcoin over the next few to several months, Gabe?
I think I'm a little bit on the camp that we are probably going to get either. I think we're going to get a pause
Clarify.
probably starting very soon, and a
Yeah.
rate cut sooner than September, probably in June.
Mm. Oh,
Um,
okay.
I I I think there's just so much leading data that's telling us that
Yeah.
that's telling us it's going to be okay too. And
Mm.
I think what people need to remember is just the long variable lags that you see in monetary policy with with such an aggressive,
Yeah,
rate hiking path that we
absolutely.
saw
That's
last
one
year,
thing that's not factored into a lot of
I
people's
think we're
thinking.
just
Yeah,
now
yeah,
starting to scratch the surface, maybe on
yeah.
some of those potential implications that they've placed in the market. So I wouldn't, I like to think, I'm going to be a little bit contrarian, but I'm starting to see, I think, a lot of other, maybe not BlackRock, but some other big names starting to kind of call for this type of pivot, which is something that we were looking at back in December with our 2023
Yeah.
outlook.
Yeah.
When you looked at the leading economic indicators index, it was screaming, and you look at the inversion of the yield curve, these things are kind of screaming, that there's weakness around the corner. So I understand it's tough to really kind of do that. Yeah. That type of switch. But I think, what Jerome Powell did, the Chairman Powell did at the Fed this last meeting was really just try and keep the ball, right in the fairway.
Right? Maintenance. Yeah.
Yeah. And just kind of,
I mean, I kind of think, Gabe, a few things. So basically, obviously, to my mind, apart from really sensible tweaking of the language, I mean, I think he may have mentioned pause, not at this meeting, maybe the prior meeting. Don't quote me on that. But apart from that, we're still getting Jerome Powell, hold my beer, Jerome Powell, don't get in front of me, Jerome Powell. There's really no indication that he's stopped, that they're done.
Yeah, and that's a good point. I guess if you were to
absolutely
look at the person that he is, he's I think he really idolizes a historical figure, Paul Volcker, who was famously, credited for bringing down the inflationary pressures that started in the 70s and carried through the 80s as his term as Fed chairman. I think he definitely wants to be, a Paul Volcker type-esque figure. And when
he doesn't want to be Ben Bernanke?
Probably more Volcker. He wants to be like I think he's like 6'6" or something like that. He wants to have that stature, with him in the history books.
I remember Paul Volcker was the tallest, apparently. Yeah.
Oh yeah.
Yeah,
but
basketball player.
I do think you can still be, he's done a lot of work already. He's really, I don't know if there's too much of a precedent of rate hikes, in the recent decades. There's certainly not. You have to go back to, I think, the Volcker era where you see such sizable moves in policy rates. So as it pertains to crypto.
Yeah. I mean, we've gone from the intensely personalized. Now let's get back to the entirely decentralized Bitcoin slightly.
I think you just gotta see the reaction in the prices and how the markets and traders, investors really are just really quick to kind of bid up digital assets whenever you start to see that. So it's really hard, I think, to be on the sidelines and patient and waiting, for the full green light, everything's clear, and then jump in. It's, digital assets, I think, and Mike McGlone said it, we'll say it again, fastest horse in the race. It's going to be very, very tough if we do get that shift in the macro headwinds to kind of be patient and jump in. I would say, it's something that you probably need to consider buying into, if you're considering, sooner rather than later. So that's, be my personal advice. But
so the upshot is, Gabe, rightly or wrongly, it looks like institutions are almost falling over themselves to actually be involved, to react to whatever's happening, whatever side, whatever direction, whether it's to, put on some positive bets or put on, some bearish trades, sort of express their intent in that way. And, I think what this tells me is that even though we are in the doldrums for some markets, we're in an uncertain place, we're obviously in not the best place that we could be. Coming from a show called CFB Talks Digital Assets, it's still a modicum of good news there because it does demonstrate that institutions are involved and they're probably more involved than they were like a year ago or 18 months ago. Do you not agree with that?
Yeah, and that's something that you can just kind of see in the data. So if you look at, open interest in the futures contracts of Bitcoin, they continue to kind of be on this upward trajectory. And, I think what we talked about in our last podcast with Mike McGlone really just needs to be echoed again, that Bitcoin, crypto is the fastest horse in this race. And that's why I think we continue to see these reactions in prices whenever we do get these slight glimmers of, possible pivots or reversals in the macro headwind, the things that we've been talking about. And that's, I think, going to continue, in the next few months. So I think if you're an investor considering allocating into crypto, digital assets, it's going to be very hard to kind of just sit on the sidelines.
Yeah,
I think
to not do anything.
It's probably a little bit quicker. Yeah, it's going to happen so quickly that you could see the price, spike rather dramatically. So again, there's also these risks that we'd like to talk about with the regulatory side. A lot of headwinds there, but we just haven't seen the same price reaction, on the news that we get from that side. So it's weighing these two things, right? So we just got to keep these two things in perspective. But so far it's been very constructive, as far as year-to-date performance in digital assets.
Well, I feel updated, Gabe, on the world of institutional crypto, which is what we try to give you when we do these CFB Talks Digital Assets. And, my takeaway, at least, or one sort of side takeaway for this, is that regardless of what's happening in the markets, the market is growing, and particularly as it concerns the larger capital market side, which we try to address. That part is growing. That's hopeful. That's promising for the industry and the markets overall. So yeah, thank you very much again for joining us for this latest episode of CFB Talks Digital Assets. I've been Ken, and I've been joined by Gabe. Thanks a lot, Gabe, and guys, we'll see you again next time.
Sounds good. See you all.